right. How you doing, friends? Ernie here, and this is 0 Days to Expiration, and this is episode number 16 of season 2. So there are actually 2 seasons. In other words, this is the second year that we have been in operation. And today is Thursday, January 26th. Sorry. And today was a very interesting day. We had a kind of a gap up, and I believe most of that was probably based on earnings from Tesla. That's my guess. And then it seemed like we were going to just take off, just keep on going, and then just stop cold. And then we just started consolidating. So that's where we've been for the remainder of the day. Have moved a little bit higher. Let's see. We've moved a little bit higher. In order for, I had a trade on, and it was a Batman. And a Batman is 2 butterflies, out of the money butterflies on either side of the market. We call it a Batman because it looks like Batman's ears. And for the majority of the day, we were sitting right between there. So at some point, you have to decide, hey, I'm going to let this go. And it was a good decision because had we stayed in it, it really wouldn't have fared any better, even though now, late in the day, it's starting to move towards the call side or the bullish side, but not enough. Just one of those days we take a small loss, or at least I did. I think other people may have done a slightly different trade and maybe got lucky. I don't know. That's where we stand today. So I'm not going to be able to show you a trade going into the close today, unfortunately, although that is very exciting. And what we are going to do is talk a little bit about what this service is all about. And that may be exciting to some people that want to know, and old news to some others. But that's what we're going to do. And then we'll do a little roll call of the people that are online. Thank you very much for being here. And yeah, that's what we'll do today. Oh, by the way, I wanted to let you know that Bitcoin Bob is now on our side. I don't know if you can see him back there, but see, he's got the Zen Swish logo on his chest now. I won't be beating him up today. However, if he ventures off over to the Bitcoin side again, he'll just get a nice sound beating. All right, what is it that we do here? 0 DTE. What is 0 DTE? 0 DTE is a very interesting phenomenon, and it has evolved over the past couple of years, and particularly over the last year, and become a very popular thing for people to trade, and for a wide variety of reasons. Now, 0 DTE, in a generic sense, applies to all options. But from a trader's perspective, when they hear 0 DTE, they think about trading options on the S&P index or the E-mini futures on the very last day of expiration. And of course, 0 DTE as a more generic term is the last day of expiration of any options contract. Most options have monthly contracts, and we all know, if you're into options, that the premium or the time premium is a big portion of the value of an options contract. And it's what really supplies a lot of the wonderful things that you can do with options. It can work against you or it can work for you, depending on what side of the buy-sell equation that you're on. But that premium is constantly decaying as time ticks away on the options contract at an exponential rate. Now, in the beginning of its lifetime, it's going super slow. And then in the last waning days of most monthly, and then the last day, it just is going really fast. Now, if you're long an option, that means the value of your option is decreasing. So you have to make sure that you're going in the right direction so that you can capture, hopefully, some intrinsic value in your option. If you're not, then the only value you have is time value, and time, as it ticks away, that value goes away exponentially. Now, as a seller of an option, you're on the other side of the deal. You're collecting that premium. You sold that option to the long buyer, and you have an obligation to make delivery upon the terms of that option. And the buyer of that option has the right to take control of what is supposed to be delivered for that option, which is, for most things, it's a stock, right? For the SPX, there is no underlying stock or anything like that, the index, because it's a calculated index. So the only delivery there is actually an exchange in value, so it's cash settled. So that's a neat thing. That's something that puts the SPX in a very nice position from a trader's point of view, because they don't have to deal with all the messiness of handling 100 shares of something or a futures contract. It's just, hey, here's the value. Either you debit or credit your account. So what most people like to do with options on the SPX is they like to trade that very last day and be, I guess you would say, net short those options. Net short meaning that you're primarily looking to collect premium from that strategy. And there's a number of different types of strategies that you could play that are really well designed for collecting premium too. So things like a straddle or a strangle, or a butterfly, or an iron condor, or a calendar spread, or a diagonal. Any of those are uniquely designed to take advantage of the premium that is decaying. And if you're in the right spot, you can collect that. The cool part about the SPX, or any kind of derivative that you can trade options on the S&P, such as the SPX index, it's a little child, the XSP, which is 1/10 the size of the SPX, or the E-mini S&P futures contract. Not only do they have monthly options, but they also have weekly options. And unlike most weekly options that only expire on Friday, they have weekly options that expire every single day of the week. So now you have this rather unique opportunity to be able to play that exponential decay 5 days a week. So this makes it particularly well suited for a day trader. All right, so now I've given you the setup of why you would want to trade this, because you have options expiration 5 days a week, lots of premium. It's wonderful. Cash settled. It's spot on. And if you have the right broker, you can even trade the SPX 23 hours a day, which makes it even better. But most retail traders don't have the right broker, or the brokers that are in the United States that are generally used by retail traders do not allow you to trade it 23 hours a day. You're trading it just in market hours. However, Interactive Broker is one of those that will trade it around the clock. I believe TradeStation will also allow you to trade it around the clock. And for those people that to trade outside of market hours, or perhaps you're in another time zone, or you just want to take advantage of all the different things that could happen outside of market hours, you could also trade the futures, the E-mini S&P futures, which are traded 23 hours a day as well. Now, a lot of people might ask, what about the SPY, Ernie? Can I trade the SPY? You could trade the SPY, but you wouldn't want to. And the reason why you wouldn't want to is the type of option that is on the SPY. The type of option that is on SPY is very similar to any other ETF or any stock. It's an American-style operation, American-style option. And what that means is that you can have early assignment. Now, remember I said that there's an obligation of the seller of that option to deliver something, the underlying. And it is also the right of the buyer to actually receive that underlying at the price that they want. That's a problem with American-style options, because you can have early assignment. So in other words, if you're the seller and you get too close to options expiration and too close to the strike price, or in the money, and you're in the money, you could be assigned. And you don't want to be assigned. And the reason why you don't want to be assigned is that it may not be your plan. As far as a day trader, if you're just trying to make money off of the premium, the decay of premium, you don't want to have to deal with the margin requirements of holding a bunch of stock. So that's one of the reasons why you don't want to trade SPY, because it is essentially a stock, and there's a chance that you could be early assigned. And most brokers will kick you out of that trade if they feel that you don't have the margin to be able to handle however many shares that you might be obliged to take over. And so that's really the problem with American style. Now, on the SPX, the XSP, and the E-mini futures, the options there, they are European style options. And so what that means is that you can't get early assignment. There's no assignment until after expiration. So that means that you can then take that 0 DTE right into expiration. And if you're in the right spot, you have the chance of maximizing your return on your trade. And so that's a really desirable thing for someone who's day trading these things. They don't want to be encumbered with the assignment and have to worry about that prior to that point where you can collect the maximum profit. And that's really key, because those waning hours and waning minutes is when the decay is happening at an incredible rate. You can literally see the premium building minute by minute when you get right down to the last minutes. As an example, you could be in a very simple butterfly, for instance, and you could have maybe, I don't know, you've logged or you have unrealized profits of, say, $1,000. But you could have another $1,000 left with only 15 minutes left. Now, you don't want to get kicked out of that position if you have $1,000 that you could potentially make, and not only get kicked out of it, but potentially get kicked out at a loss, because they don't give you the option to get out at the time that you want to get out, or get assigned a whole bunch of stock. You just don't want that. But with the SPX or the E-mini, that's really not an issue. Now, with the E-mini, if you do go into expiration, you may enjoy the benefits of the profit that you made. But if you're in the money with any of the legs of your position, you will get assigned an E-mini contract. So for that reason, most people that trade the futures tend to wait until the very last minute and then exit the position before they go into expiration. So those are the big things that you have to really watch out for as someone who's into 0 DTE. But they're minor things. So anyways, the whole point of this is that it's a fantastic vehicle and opportunity to make substantial profit. Now, there are a wide variety of ways that you can trade this and different styles. But generally, you're trying to collect that premium right up to the end. Some people will go for very high probability strategies, putting on lots of risk and trying to go for what they call income producing strategies, which is a misnomer. And then there are the other side of the coin, people who are more interested in collecting the return and putting on capital efficient trades. So in other words, they want to put on the smallest amount of risk for the maximum amount of gain. And that's really the smart way to do it. And that's the way a pro would do it. A retail trader would actually go for the strategy that would produce the best dopamine drip. If you don't know what that means, that dopamine is a chemical that makes us feel good, that our body produces. When you eat chocolate, it actually raises the dopamine levels in you by more than 50%. When you smoke a cigarette, it raises it by almost 100%. When you do cocaine, it raises it by about 200 or 300%. So dopamine, you also get that rise in dopamine every time you get something that affects you positively or makes you feel good, like winning. And if you're making a lot of these tiny, small wins, that you're essentially like injecting yourself with a little bit of dopamine all the time. And it clouds your vision or your judgment a bit, because it makes these tiny little wins seem like they're more than they actually are, and hides your head from the pending risk that you have of that huge amount of risk that you take for the privilege of getting a high probability win. However, from a retail trader's point of view, that's fine by them because they think that they can just get get that risk out of their mind and deal with it when they have to. Of course, this is like the bane of the existence of any retail day trader. And it's also the reason why the vast majority of retail traders fail. 98% of retail traders fail. They may not fail in the first 3 months, but in 90 days, 80% of them gone, account wiped out. But eventually, 98% of them, they will lose all their money. That's from a retail trader's point of view, that out of sight, out of mind. And in the meantime, just keep on injecting that dopamine. I'm fine. From a professional trader, we're looking at the long term. Everything is about long-term returns and consistency, not over weeks, not over months, but over years, year after year. You want to be able to know that you can go into the market and consistently take a return and be pretty predictive about the amount of money that you put into it and what you'll get out of it. Now, it's not easy just to do it, just to say, hey, I trade this way, that way it happens. A pro trader needs to be skilled. They need to develop a process. They need to develop the correct habits and a continuous improvement process that will allow them to recognize when they get off track to get back on track. And that's really what a pro is all about. A pro is all about perfecting the fundamentals of everything that they do, not just their execution, but every aspect of their trading life, from the time they wake up to the time they go to bed. It's really that simple. And on top of that, you have to be, like I said, in this kind of continuous improvement process, which means that you have to be able to journal and log your trades and analyze them in such a way that you can recognize or see patterns of behavior that are getting you off track. One of the biggest things that hurts people in the short term is something called, if you've ever played poker, then you probably know this term, and it's called going on tilt. And it's a death spiral that you get into. You think you're doing well, and then all of a sudden you start making one bet, you make a loss, you think you're going to make up for it, so you double down or you do something stupid. And then before you know it, you've gone from what appeared to be a winning streak to in the debt, in the dregs of despair. And that's something that a pro very rarely does. I'm not saying that it's not possible, but because a pro is looking out for those signs, those signals of getting off track, and then knowing how to evaluate it, knowing how to discover it, and then come up with the cessation or the plan to get yourself out of it, is a regular experience with a pro. A retail trader, they're still on that dopamine drip, and they think everything's going to be okay until everything isn't. So that's what I want to tell you is the difference between what we do here at Zero-DTE and what every other service that's out there that is doing Zero-DTE, or virtually any other service that caters to retail traders, alert services and other services on top of that. They're not really teaching you how to be a pro. They're teaching you what you think that you need to know, and that is high probability strategies to feed that dopamine drip, to get the immediate satisfaction, and really leaving you unguarded in the event of something really bad happening. I see comments happening here. I'm going to go to there, and we'll do a little roll call too. This is great. Okay. How you doing, JMO and Iz and BBB? How you doing? Jacob Wall has a question. He says, cash-settled index options also come with the 1256 tax advantage. So what Jacob is talking about there, and you also have the same tax advantage with futures, by the way. What that means is that you get special tax dispensation. When you're trading regular stocks, for instance, or anything that doesn't have the 1256, and you make profit, you're taxed at your nominal tax rate, whatever that happens to be. And so if you make some good money and you're taxed at the highest tax bracket, then all your profits on your trading are going to be taxed at that rate. When you trade futures or the SPX and options on those, you get taxed a very different way. Now, we all know that most people, when they buy stock, they like to buy and hold for a certain amount of time so that they don't have to pay this nominal rate of taxes. They can pay the capital gains rate, which is much lower. Well, with futures and the SPX, you don't have to hold for a long time. You just have to trade them at any time. And 60% of your profit is taxed at the capital gains rate, while 40% is taxed at the nominal rate. I believe that is, or is it the other way around? Anyways, you get a huge discount. What essentially is happening is that you get about a 15% edge over people that are making making the same amount of money on stocks versus the SPX or futures. Yeah, that's a huge advantage. Thanks for pointing that out, Jacob. Joto, SPX versus RUT. I am trading one system on RUT. It's a little easier for buying power, about half of SPX. That's fine, except that when you're now RUT, I believe, I'm not sure if RUT actually has 5 days a week, 0 DTE. If it does, that's fine. But RUT would probably put you in the same kind of category as the NDX. So RUT would be the index on the Russell 2000. And the problem with the RUT is liquidity and volume. The liquidity, just like on the NDX, you would think that the index would have a lot of liquidity on options, but it doesn't. It has very little liquidity. And so what that really means is that your spreads are going to be unmanageable. There's not going to be enough people, third party or counterparties, to be able to take your trade. It's really just a horrible way to trade 0 DTE when you want that liquidity. You want to be able to get in and out of a trade so that you can maximize your returns. RUT, in my view, is just not an option. Neither is NDX, by the way. Actually, RUT is worse than NDX. And it's wonderful that you have the kind of volatility that it has, but if you can't get a halfway decent price on your option, then what good is it? And and SPY equals assignment risk. That's because it's an American style option as opposed to European style option. All right, another question from Joto. Trading multi-leg strategies on an American style option can get messy fast. That's true. Well, I don't know. It really comes down to how you trade it, right? If you're talking about expiration, that's one thing. Trading it prior to expiration, that's a different thing. Jacob has another comment. You save roughly a third on taxes by trading cash settled options under the section. That's quite a bit, right? Imagine if you had somewhere between a 15 and 30% edge on everything that you trade. Of course, you have to be a winner in order to take advantage of that edge. Right? Joto says, hey, Wall, that's only for U.S. people. Here in Finland, everything is taxed the same. I'm sorry about that. Get yourself a U.S. address or something. I don't know. Yeah, unfortunately, that's what you have to deal with. And of course, being in Finland or anywhere else other than in the U.S., you also have to deal with the time difference. Now, at zero, although people figure out a way to make it work, and even with that, the fact that you're not getting that tax advantage, the 0 DTE trade is such a compelling option that it really doesn't matter if you have the tax or not, or if you're outside of the country or not, you're in a different time zone or not. People want to trade this because the opportunity to make money is big, right? Of course, it's very attractive, but if you don't know what you're doing and you're trading like a retailer trader, I don't care what the opportunity is. I don't care how well or how much edge it has. You're going to find a way to screw it up. Jas wants to know, what's the play today? It's the same play every day. We get in with butterflies. In this case, we usually get in with 2 butterflies on either side of the market. And then we play and we manage the profit. And today that didn't work out, so that's it. So getting into the trade is the easy part. Anybody can get into a trade. Where you make your money is when you push that close position button. Closing the trade at the right time with the right knowledge is how you make money. It's not getting into the trade. You can give somebody all the best possible setups every time. And if they're a retail trader, eventually they're going to screw it up. That is a fact. And you may not think that's a fact with you, but I am willing to take your bets. your trades. I will finance them if you allow me to, and that would be the best investment I could ever make. That's how confident I am. Oh boy, we got an argument going on here. Yeah, but one should really, let's see. E-mini options usually offer the same capital efficiency to the trader with portfolio margin who is trading SPX. That is very true. And then Yoto retorts, but one should really start small to get used to the span margin. It's not a static thing. The margin requirements grows near the expiry date. If you're really worried about margin and how small you are, you can trade super small. There's nothing stopping you from trading 0 DTE with the XSP or the E-mini. In fact, last year, when I first started this service, I started in 2021. I wanted to show that you could trade with a small account. And not only did we not trade with the small margin XSP or the SPX, we trade with the E-mini futures. I traded with a small account. In 9 months, I tripled it, starting with only $3,000. So you can trade super small. Margin should not be your problem at all. How you doing, Jay Hen? Good to see you. All right. And then, okay, Jacob and Yoho, you need to find a different place to argue. It's a good argument, though. But Jacobs comes back as, yes, absolutely. Margin can be a very poor reflection of risk, depending on the strategy and instrument. Sure. But in this particular case, margin and commissions, if you trade it the right way, then they are minimal detriments to your trade. As a matter of fact, that's one of the primary things that we do that it's very different. And that's what most pros do, is that they trade capital efficient. In other words, they take very tiny risks for huge outsized profits, asymmetric returns. If you trade that way, then margin and commissions, even if they are the highest commissions, the ratio between that and the profit that you're going after makes it really a non-factor. Now, the people that are worried about that are the retail traders who are trading not that way. They're trading the exact opposite way. They're looking for those small returns, and then margin and commissions make a huge difference. And again, that's another contributing factor for the reason why most retail traders fail, right? So I can tell right now that Yoto is a retail trader. That's not like a smear or anything. It's just a fact. You think that way, and then you don't see the benefit of the other way. 30 Minutes Nirvana says, I tilted a couple of years last year. Yeah. I've tilted many times. When trading long enough, one can sense when the tilt danger is near. That's maybe. You might be one of the lucky ones. But I know people that have been trading for 30, 40 years, and they think that they're crackerjacks. And they are not immune to it. They are not. Unless you have a specific process for dealing with things that get you off track, virtually anybody can fall prey to that tilt. How you doing, Rob? Rob Fresno's there. When trading is boring, it's done right. I have to say that's probably true. But I'm telling you right now that pinning a trade is friggin' exciting, no matter how you look at it. And to think that you can just eliminate emotions in trading because, you're some sort of stoic guru, it's all bullshit, right? You can't control your emotions. So what you have to do is you have to develop processes that allow you to steer clear of those things that create emotional baggage. All right, here's another comment. The time difference is pretty nice. My normal job is the U.S. market just opened, so I can do both without multitasking. That's a good point. There are also people that are on the West Coast or even in Hawaii that trade that have that similar setup, or people that are in Europe. We actually have people, I believe, members of this service that are in every single time zone on the planet. Jacob says most retail traders would literally lose even with inside information of the earnings report or something or of the sort. Yeah, I agree with that 100%. And it is right that psychology makes a difference, but it's more about controlling your psychology and putting yourself in the right situation and having a way to deal with it, having process to deal with it that allows you to manage your emotions. Now, there's just no way to eliminate emotions. They're there no matter what. However, it is also a skill to treat your individual trades as if they're just like another nail in a board, right? So imagine that you're building a house and you're framing it up. Every nail is just like every other nail, right? You want your trades to feel that way, but the only way to do that is to make them not really hurt if you get into trouble. And the only way to do that is to trade with asymmetric returns. You need to have very tiny risks that you can manage and more or less brush off, and then outsized returns that you can then concentrate on managing your profit instead of managing the risk. As a matter of fact, that's another real big difference between the retailer and the pro. The pro manages profit. The retailer manages risk. I like to say that, well, really, the retail trader is managing how to lose while the pro is managing how to win. Yeah, the pin trades are really pretty cool. And with our strategy, with the simple butterfly out of the money butterfly, your chances of a pin are relatively small, probably around 5 to 7%. However, there's also a spectrum of nice profits from the small risk to that pin trade. With the butterfly, it actually increases it dramatically. And the two things that the single out of the money butterfly and the Batman trade have in common is that they both are asymmetric trades, and they both have skewed long tail distributions. The difference is on the Batman, that long tail distribution. When I say long tail, that's really big outsized winners. Retail traders, when they're trading high probability strategies, do not have long tail winners. They have long tail losers and small winners. Pros trade the other way. They have small winners as well, but then they have the long tail winners and they have small losses, right? So that with the Batman, you get that long tail, but it's a fatter tail. So you have the long fat tail, and that's the ideal situation that you want to be in. Sorry, we'll have to call you later. All right, so there's the rundown, the difference between being a pro and being a retailer. And it's also the difference in what we do here compared to what every other service does. Most other services are focused on shoving at you what you believe are good trades. And what we do is turn you into somebody who is completely independent and can tell for yourself what's a good trade and then manage it. All right, there you go. There's the difference. All right, that's about all I have to say. I don't have much else to say except that Tesla is off the hook. Oh man, love that. Yeah, I've been on Tesla now for the past month and a half. Jacob says, of course, a long-tail loser is mathematically very different, if not impossible to come back from. And that's really the problem, too. There are certain types of strategies that a lot of people think that, oh man, this strategy, it's so great. I make profits left and right, and I can manage my losers, except for when you do. Strategies like selling puts, for instance, or the wheel strategy, or any kind of high probability strategy where you potentially have huge risk. Like some people that are trading 0 DTE with iron condors, as an example. They're usually putting up $1,000 so that they can make $50. Now, man, if you hit that max loss, it's going to wipe out literally weeks, maybe even months of your profits. Same thing with the wheel strategy. If you get into the wrong position with the wheel strategy, you dig yourself into such a big hole that the size of your profits may be insurmountable to overcome that loss. Yeah, and that's again, and it's also the hole that retailers drop into. And it's one of the reasons why they think that they have to double down in order to be able to climb out of that hole. The secret is to minimize your drawdowns and minimize the volatility on your equity curve. And the only way that you can do that is through asymmetric trades. It's really the only way. Even if you're trading a high probability strategy and think that you have the risk management nailed, eventually it's going to get you. It's almost a certainty, except for about 2% of the people that manage to get around it. With everybody else that has the same story, that they can manage that risk, they all eventually succumb. It's just, like I said, it's just a matter of time. Just a matter of time. It's a good bet. Like I said, I'd love to take all your bets. I'll put up my account and you can trade against that account. That'd be great. I'll take all your trades. I'll take the opposite side of all your trades. It's probably, if you could do that, I don't know if obviously you can't do it unless you're a broker. But if you could do, that would probably be the best strategy of all time. Taking retail traders' trades. Oh, man. So anyways, that's all I've got to say. Thank you very much for all those great comments in the peanut gallery. Thank you very much. Peace be with you. And we're going to get out of here. I'm going to go shake Bitcoin Bob's hand, who is no longer known as Bitcoin Bob. See, he's got the Zen switch there. Take care. Peace. Time for the music. Is the strategy scalable? Of course it is. We're getting there, guy. Don't worry. The strategy is infinitely scalable. Dog is doing much better. Thank you.